What's going on, guys? Chris here with Retail Algo Trader. The date is October 15th, and this is going to be a real-time overview for the week of October 15th through the 19th. We'll be using a simulated account to simply annotate the trades we're actively taking, as well as the process of building the trade and to demonstrate the risk-reward associated with these trades. All trades will be conducted with a single contract per strike to show the value of profit and loss per leg. Before we look at this week's trades, let's take a look at last week's trades. Alright, what's going on, guys? Going into last week's trades, we'll try to make this a little quick because we got a lot to go over. Starting off with the market dropping there on Wednesday, big volatile move, kind of set the mood for the rest of the week of being high volatility. We had a Wednesday drop, Thursday sort of drop, and kind of mellowed out. And then Friday we had that bounce pretty much across the board. So going into our first play here, we got Verizon top left. Verizon, with the initial play that we had a 12 October 53.5/53 put spread. On Thursday, that did end up going in the money with a Friday bounce, taking it back out of the money. So that did expire worthless on Verizon, and we took the full 14% return, which was 100% of what we could have initially taken. So it was a full premium collected on Verizon. Swinging over to QQQ. QQQ was an original 172.5/172 put spread. As you can see up here on the chart, we did end up going in the money on Wednesday, followed by Thursday, sort of bouncing back and forth. And then on Thursday, we actually added a hedge to that play. We added a 174/175 call spread to hedge that put spread. So kind of like turn it into a little iron condor type of deal. But with that reversal Friday, that ended up shooting that call side in the money. Fortunately, we were able to get out on the way up. We ended up getting out with, we had an initial possible return of 16%. And that was with a $7 max profit. If you're trading one contract, you would have had a $7 max profit with $43 risk. So we had a 16% max return. Due to the hedge, we took in more premium, so when we closed the trade out early, we actually took $9 instead of $7, which gave us a 21% return on money risked. So we did collect the full, full premium of the initial play. So I guess you'd say it's 100% efficiency on that trade. But we actually, with the hedge we took in and closing the trade out early, we actually collect $2 more than initially planned. So we took a higher percentage return than what we were anticipating taking in the first place. So moving over to Apple over here in the top right. With Apple as an iron condor, and it expired, worthless as you can see here on the chart. It went down, kind of bounced around on Thursday around our put side, up on Friday, and just kind of expired right in the middle of our range. So that was a 34% possible return, and we did end up taking that full 34%. Alright, so moving down to the middle left here. Middle left is V, ticker symbol V, that's Visa. With Visa, we had an iron condor. It expired out of the money. We collected 30%. With V, our initial iron condor was 136/137, and then the gap went to 145/146 for our call side. We had a possible return of 30%. We collected the 30%, so 100% efficiency on that trade. We went in the money, and just like the majority of our plays, we bounced back on Friday. Never really made an adjustment to that trade. Never saw a reason to, just based off of intraday price action. So we end up collecting the full percentage on that. Moving over to IWM, that's ticker symbol IWM. That's the Russell 2000. With IWM, we had an original iron condor, and that was established with the 12 October 156.5/157/165/165.5. We went into that play with an initial intent of 22% return, but what happened was on Wednesday? Wednesday with that drop, our puts did go ITM on the crash. We added on Thursday, we added an additional call leg of the 159/160s, and that was to do a call leg, a call spread. The put side went and expired ITM, but both of our call legs expired OTM. So we actually did, that hedge kind of worked out nice in our favor, kind of reduced loss. So we ended up actually losing 32% on that trade. So it was a negative 32% trade right there. Moving over to the right, we have AAL. AAL American Airlines, that was original iron condor. The put side did go ITM, on that crash day. We added an additional call leg on Thursday of 32.5/33.5. The puts expired ITM and the calls expired OTM. So we were left with a negative 32%. As you can see right here on the chart, with the greens being, expiring OTM and the red expiring ITM. So that one right there did expire in the money. We ended up losing 32%, which was actually a lesser loss than we initially would have had. Due to the hedge that we made, we basically cut our loss substantially, and we ended up only losing 32% on that trade. All right, moving down to the bottom left, that's SPY. Everybody knows SPY, the S&P 500. With SPY, we had a call spread initially going into the week, and that call spread was established with the 291/291.5s. We had an initial return of 14%, but with that giant drop, with our 291 up there, our top leg for our call spread, that giant drop on Thursday or Wednesday going into Thursday, mellowing out on Friday, we saw opportunity. We added an additional call spread of the 282/283s, took in more premium, and good for us, both of those call legs did expire out of the money. So what would have been an initial 14% return, by adding that extra premium, we took in more premium. We actually ended up taking a 35% return on that trade on money risked, for a total 100% efficiency on that trade. So taking in that hedge, paid out, we actually ended up taking in more premium, all said and done. BABA right here, BABA, that's Alibaba Group Holdings, and that was an original call spread, which did expire out of the money. Never saw any reason to adjust it. Premiums weren't really in my favor as far as high probability, 78% range. I never really saw anything that I wanted to add additional to that play, but that did end up expiring out of the money. So we did collect that full total return of 11% for 100% efficiency on that trade. And last but not least is BIDU. BIDU was an original iron condor. And that was established with the 187.5/190/212.5/215. We went into that trade with a possible 16%, and being that it expired, sort of right in the middle of the range, both sides expired out of the money, and we ended up collecting that full 16% for 100% efficiency. So that was last week's trades. If you guys have any questions, throw them in the comments section or shoot me an email at retailalgotrader.com. Let's go into this current week's trades. All right, what's going on, guys? Chris here with retailalgotrader.com. We're going to be going into this week's trades, and the sequence of events we're going to be doing here, we'll be starting from the top left, going down the bottom left, swinging up the top right, going down the bottom right, just so you guys can stay along. All the trades we're going to be talking about here, they're all between 75 to 85% probability, and we find that by using our rangefinder tool here. You can see on the chart, it gives us our estimated probabilities of where we can expect that stock going by expiration date of the contracts we're trading. It'll give you stuff like your IVP, your float, your 1 year plus or minus max move, as well as your dividend X date and the dividend amount you can expect that the day you can expect that dividend amount, to drop, be adjusted in the stock price. If you like that indicator, if it's something you want to use, swing by retailalgotrader.com, check it out. We also have a bunch of other indicators and automated strategies. So going into the trades, starting off with top left, we have BABA, that's B-A-B-A. We took a call spread on this. The majority of the trades we're going to be talking about, they're all call spreads except one iron condor. There's not much bullishness in the market today. Today is Monday, October 15th. All these will be expiring on the 19th. Didn't really see much bullishness today, throughout the scanners that we use. So we ended up taking call spreads on the majority of the plays except one iron condor, which was on Facebook, and we'll go over that one. So BABA, we took a 150/152.5. This gave us a $35 credit for a $215 max risk. If everything goes as planned, we'll take 16% return on this trade. And you can see our fill price here. We took in $35 credit. There's our fills right there. If everything goes as planned, we'll take in about 16%. Moving down to the bottom left, we have Citigroup. That's another call spread of 71.5/72 for the contracts. It's a $7 credit with a $43 max risk. If everything goes as planned, we'll take in 16% return on our money. Going to the top right, we have Facebook. Facebook was an iron condor, just sort of, due to that doji kind of forming up there for today. You starting the week off with a doji, it could go anywhere the rest of the week. So being that it could pretty much go anywhere, we want to establish a neutral position using high probabilities, 75 to 85%. We took an iron condor established with a 146 slash 147. That's for our put side, and then for our call side we did 160 slash 162.5. So we actually have a little bit more risk on the top side. But being that, my consensus is neutral to bearish for this week, a higher risk on the top side was acceptable for me. They gave us a $39 credit with a $211 max risk. If everything goes as planned, we'll take 18% return on that money, on the money risk there. Middle right here on the side, we have Microsoft. Microsoft was in call spread established with a 111 slash 112 call. We took in $16 credit for $84 max risk, and if everything goes as planned, we'll take in about 19% return on all money risked. And last but not least, we have NVIDIA. That's bottom right. That'll be in another call spread, and with that call spread is established with a 250 slash 252.5, so that's $250 strike difference. We took in $42 credit, and that'll put our max risk at $208. All these numbers are pretty much assuming that you're just trading one contract, per leg. If everything goes as planned on NVIDIA, we'll take in about 20% return on all money risked. So that's this week's trades. If you guys have any questions on these trades, feel free to comment in the section below, as well as swing by RTOalgotrader.com. You can shoot me an email. My name's Chris. Have a good week. We'll see you next week when we go over these trades as well as the following week's trades. Thanks for tuning in to the Retail Algo Traders YouTube channel, where we provide education, tools, and mentoring. Visit RTOalgotrader.com to get custom indicators, automated strategies, and mentor sessions. Be sure to subscribe to this YouTube channel so you can get the latest content we create. And as always, happy trading.